Welcome to Trading an Edge, the podcast where we break down the psychology, mindset, and system of elite trading. Today, we're taking a deep dive into some really critical material you've shared with us, all centered around a powerful idea, how you can move beyond just, market speculation and truly engineer a quantifiable edge. We're talking about the fundamental differentiator for serious traders: positive profit expectancy.
That's right.
Because for far too many, I think, trading still feels like a bit of a gamble, right? Driven by gut feelings or this endless quest to be right on every single trade. But what if we told you there's a systematic approach that fundamentally shifts that entire perspective? An approach that moves you from guesswork to calculated engineering. And here's the disruptive truth that really frames our entire deep dive today. An edge in the market isn't some fleeting feeling or, a magical signal. It is simply having a measurable, positive profit expectancy.
That's the core of it.
And if your trading plan cannot demonstrate that positive expectancy, you are not trading. You are gambling. It's that stark, that uncompromising, and honestly, that vital.
Indeed. And our mission today really is to demystify this concept of profit expectancy. We want to reveal why it's arguably the single most important statistic for your trading success. We're going to unpack how to think about it, what influences it, and why truly understanding it can just transform your entire approach to the market. Think of expectancy like the engine in a car, all the fancy gauges, the paint job. They mean absolutely nothing if the engine doesn't run.
Right. The fundamentals have to be sound.
Exactly. Or maybe think about it like building a rental property. Every positive expectancy trade you make, that's like a consistent rent payment. It compounds over time, building your long-term wealth. You need to treat each trade almost like a tenant that must pay into your long-term cash flow. This is really where math, discipline, and repeatable process turn raw speculation into a demonstrable edge.
That's a powerful way to frame it, and perhaps a bit confronting for some of us listening. If this truly is the engine, the foundational piece, then we really need to know what goes into it. How does a trader actually quantify this? Can you walk us through the core components?
Absolutely. At its heart, profit expectancy quantifies the expected return per trade. It provides a clear assessment, of the long-term viability of your strategy. It's the foundation of sustainable trading success. It's that mathematical advantage that, when you apply it consistently, increases the likelihood of profitability over time. The simplest way to grasp it is by weighing your average wins against your average losses, and then factoring in how often each of those occurs.
Okay, so how does that look in a formula?
Well, the general formula, it starts with profit times the probability of winning minus loss times the probability of losing. Simple enough. However, in trading, unlike, say, a casino game where the payout for hitting red is always the same, your win and loss amounts aren't fixed, they vary.
Right, trades are different sizes, wins are different sizes, losses too.
Exactly. So we use an adjusted formula to account for that variability in your trade outcomes. It looks like this. Profit expectancy, average profit X, probability of winning, average loss X, probability of losing. And just to be crystal clear, probability of winning is simply your win percentage.
Yeah.
And probability of losing is just 1 minus that win percentage, or, your loss percentage.
Okay, that formula, it instantly shifts the focus, doesn't it? It moves you away from that anxiety that need to be right on each individual trade to really understanding how right you are overall across a whole series of trades. It's less about the single tree and more about the health and growth of the entire forest, so to speak.
Exactly. That's a great way to put it. Individual trades are inherently uncertain. We all know that. You can never predict a single outcome with 100% certainty. But a positive expectancy ensures profitability over a series of trades. And that emphasizes the paramount importance of long-term consistency. This metric, profit expectancy, it effectively compresses your system's real-world performance into one single actionable number. It gives you this clear, unfiltered lens on whether your strategy is actually making you money over time, cutting through all the noise and emotion of individual wins and losses.
That makes perfect sense, focusing on the overall health of the forest. But I know for many traders, there's still this huge psychological pull towards a high win rate. It just feels good to be right more often, doesn't it?
It does. It absolutely does.
So why isn't a high win rate alone the golden ticket? Why is focusing on this single expectancy metric so much better than just, obsessing over your win rate?
That's such a critical question, and honestly, it's where many, many traders stumble. It's quite remarkable how often traders obsess over win rate alone, without really considering the magnitude of their wins and losses. One of the sources we look at gives this fantastic analogy. It says, imagine if someone told you that they devised a way of helping you to lose 60 pounds in a week.
Okay, sounds impressive.
Right. Sounds pretty impressive. But the astute observer, the smart person, has to ask, okay, 60 pounds of what?
60 pounds of what? Ah, that's brilliant. I see where you're going.
Precisely. You could lose 60 pounds by, say, cutting off a leg, but clearly that's not a desirable outcome.
Definitely not.
And high win rates can be similarly misleading. They can look great on the surface, but if your average loss significantly outweighs your average win, the math just doesn't work. You could have a strategy with, say, only a 35% win rate, but it could still be very profitable if its average winning trade is substantially larger than its average losing trade.
Right, so those few wins really count.
Yes, exactly. Conversely, you might be winning 70% of your trades feels great, right? But if your losing trades are massive, just one huge loss could easily wipe out dozens and dozens of those small wins. That makes your overall expectancy deeply negative. So it's not just about how often you win. It's crucially about how much you win when you're right versus how much you lose when you're wrong. That balances everything.
This distinction between gambling, which relies on fixed odds, and trading really stands out here, and I imagine one of the core differences lies in how we approach probability itself. In a casino, whether it's a coin toss, roulette wheel, the probabilities are fixed, they're calculable, it's kind of a closed system.
Divine variables.
Yeah, but trading feels so much more dynamic, more open-ended. So this raises a really important question. Can we calculate expectancy as precisely in trading as we can in those games of chance?
And that's the key difference, isn't it? In those games of chance, the outcomes are deterministic precisely because the variables are fixed and limited. We know all the possible outcomes, and we know their exact probabilities. But in trading, think about all the factors influencing price movements, market conditions, news events, unpredictable human behavior, algorithms reacting to each other. The number of factors is virtually infinite, and it's constantly changing.
So unlike those fixed systems, trading involves all these dynamic, unpredictable variables, which means precise future probability calculations. They're essentially impossible, right? You can't just plug in fixed numbers and expect a perfect prediction.
Consequently, no, you can never calculate the exact future profit expectancy in trading. What you can do, and what you must do, is look at previous live results and rigorously, thoroughly backtested data. Historical eye performance and solid backtesting give you invaluable insights into how a strategy might perform in the future. But crucially, they are not guarantees.
They're estimates based on the past.
Exactly. They help us estimate expectancy based on past behavior. They give us a strong statistical probability, but never ever a certainty. So your job as a trader isn't to chase some elusive, perfect prediction. It's to design a plan whose estimated expectancy is positive and, crucially, robust enough to withstand real market variability.
Okay, so given that we can't be exact, that we're dealing with estimates and probabilities, what can we control? What are the practical levers you as a trader can actually pull to actively build and enhance that positive expectancy?
That's the practical question. And there is essentially two core methods, two main levers traders can use to engineer their edge, and they stem directly from how profit expectancy is calculated. Number one, you can work to increase your strike rate. This just means winning a higher percentage of the trades you execute. And number two, you can work to increase your R ratio, your reward to risk ratio. This means maximizing the profits on your winning trades while minimizing the losses on your losing ones.
Okay, let's break those down. For the first lever, increasing your strike rate, winning more often. What does that practically involve? And maybe what's the psychological trade-off there?
Well, increasing your strike rate can be achieved in a few ways. Refining your entry criteria is a big one. Improving your timing. Rigorously filtering out those setups that historically just don't work well for you, the low probability ones. For example, if you really deep dive into your past trades, your journal, are there specific market conditions, maybe certain times of day, or even particular psychological states you were in, where your win rate statistically just tanks?
Yeah, I bet most traders could find patterns like that if they looked honestly.
Right. Identifying those and then actively avoiding those specific setups or times can be a much more powerful and immediate way to refine your entry criteria than just vaguely trying to get better overall. Now, high strike rate strategies, they often rely on frequent smaller gains. Often this means using wider stop losses and having smaller profit targets. They require immense precision, real discipline in execution. The psychological upside, you get frequent validation from being right often, which can definitely be comforting, build confidence.
Sure, lots of small wins feel good.
They do. The potential downside, though, is that you might be capping your profit potential on the big moves. And small errors, or just a few slightly larger losses, can still be quite costly if your average loss isn't very tightly managed relative to your average win.
Okay. And the second lever, the RR ratio, the reward to risk. That one feels incredibly powerful when you look at the math. Your sources highlight that the higher your average RR, the less often you actually need to win to be profitable. It almost seems counterintuitive at first.
It is incredibly powerful, and it
Yeah.
speaks directly back to that 60 pounds of what analogy we talked about.
Right.
Think about it. With a 3-to-1 RR, for example, meaning your average win is 3 times your average loss, you could actually be wrong up to 75% of the time and still break even.
Wow, 75% wrong and break even? That's huge.
It's huge. It immediately highlights the profound impact of letting your winners run and cutting your losses quickly and ruthlessly. A high RR completely compensates for a lower strike rate. This makes it a really viable strategy for traders who maybe don't have an extremely high win percentage naturally, but who can handle volatility and stick to their plan. The psychological demands here are significant, though. You absolutely need patience.
Yeah.
You need the ability to tolerate losing streaks, sometimes enduring many, many small losses while you're waiting for those occasional but very large winners. It's really about being right and staying right on the few big moves that matter.
So what we're really talking about here isn't trying to be right on every trade, which is impossible anyway. It's more about strategically approaching your trading so that you're either winning more often, perhaps modestly, or you're winning much, much bigger when you are right, even if that's less frequent. It's about strategic profitability, completely divorced from ego or needing validation from every single outcome.
Exactly, you nailed it. High R strategies focus on capturing those large price movements. Often this means using tighter stop losses initially, perhaps, and certainly involves less frequent wins overall. They demand immense patience and, again, that ability to tolerate losing streaks, sometimes for extended periods without getting shaken out or changing your system impulsively. Ultimately, trading really does boil down to how much money you make when you are right and how much you lose when you are wrong. The goal is simply to maximize the gains on your winning trades and minimize the losses on your losing trades, creating a consistent positive asymmetry in your trading performance over time.
And the mindset shift that comes with truly internalizing this.
It's profound. If we connect this to the bigger picture, the psychological shift this understanding brings is just profound. You stop chasing the feeling of being right, which is ego-driven.
Yeah.
And instead, you start methodically optimizing for being profitable, which is business-driven.
That's huge. I can see how when you truly understand and calculate your expectancy, those single trades start to lose their emotional charge. They just become data points, right? Within a larger statistically robust system.
Precisely.
You start to trade more like an engineer tuning a system, making data-driven adjustments, rather than like a gambler reacting emotionally to headlines or the latest market rumor. That systematic approach has to foster consistency and reduce those damaging emotional decisions.
Absolutely. And to truly embrace this, you should be tracking your expectancy meticulously. You needed to get a true objective picture of your success or lack thereof in the market. You can track it in dollars per contract or dollars per trade, or, especially useful in futures markets, you can track it in ticks per contract.
Why ticks per contract specifically?
Tracking it in ticks per contract gives you a standardized result, regardless of the size you traded, which specific product you were trading, or even the currency denomination of that product. It offers perhaps the purest measure of your system's underlying edge, stripped of position sizing effects.
Okay, that makes sense. A universal measure of the edge itself. This balanced, data-driven perspective is truly what allows you to understand your system's real-world performance, letting you iterate and improve with actual precision, not just guesswork. So for someone listening now who's thinking, okay, I get it, I need this, how they go about actually building a trading plan grounded in positive profit expectancy. Can you maybe give us a step-by-step framework?
Certainly, and this isn't just theory, it's a very practical, actionable framework. Let's walk through it. Step 1. Define your system metrics. This is where you have to be brutally honest with your data. No sugarcoating.
Right. The raw truth.
Exactly. You need to record your win percentage, your average win amount, your average loss amount, and crucially, the sample size of trades these statistics are based on. Be absolutely ruthless in this data collection. Garbage inputs will inevitably produce a false, misleading expectancy. Ask yourself, are you tracking all your trades, including the scratches, the small losses you'd rather forget, or only the ones you like to remember? Honesty is paramount here.
That honesty component really is crucial, isn't it? It's so easy to selectively remember the big wins and downplay the losses. Okay, so once we have that raw, honest data, what's step two?
Step 2, calculate expectancy. Now you take those honest numbers and plug them straight into our formula. Average win x win percent. Average loss as loss percent. The result you get, that is your system's baseline performance. If your calculated expectancy is 0 or worse, negative, you must stop trading that system and redesign your approach, period.
That's a hard stop.
It has to be. Continuing with a negative expectancy system is mathematically guaranteed to lead to long-term losses. This calculation is your fundamental reality check.
Okay, so assuming we've done that, and hopefully we've got a positive baseline expectancy, then we move to optimizing it, right? What's step three?
Step 3, choose your lever. Now that you have a baseline, this is where you decide your primary strategy for building and improving your edge. Will you primarily focus on increasing your strike rate winning more often? Or will you focus on raising your RR winning much bigger when you are right? Remember, each path requires different trading rules, different entry and exit criteria, and crucially, a different psychological tolerance from you, the trader.
So you need self-awareness here too.
Absolutely. You need to document which lever you prioritize and why. Understanding your own psychological makeup is key. Can you handle long periods of small losses waiting for a big win? Or do you need those frequent wins, even if smaller, to maintain confidence and discipline? Align the strategy lever with your personality.
That makes perfect sense, align the strategy with you. Okay, so we've chosen our lever. Now we need to protect the capital that allows our system, our positive expectancy, to actually play out over time.
Exactly. That leads us to step 4, architect risk and position sizing. This involves fixing your risk per trade. A very common guideline is risking only 1–2% of your trading capital on any single trade. But it's not just about single trades. You then need to simulate potential losing streaks based on your system's statistics. Understand the maximum drawdown you could realistically face and set your personal drawdown tolerances. How much are you willing to lose before you stop and reevaluate? Then you size your positions accordingly, not for maximum profit on one trade, but primarily to protect your capital. This ensures your positive expectancy has sufficient time and enough capital runway to actually manifest over hundreds of trades. Without proper risk management, even a winning system can blow up during an inevitable bad run.
Okay, risk management is paramount. So we've designed the system on paper, calculated expectancy, chosen our lever, set our risk. Now comes the validation part, right? How do we test if this actually works in the real world or close to it?
Step 5, validate with backtest plus forward test. This is critical. You need to rigorously backtest your strategy across different market regimes. Don't just test it in a bull market if it's meant to work everywhere. Test it in bullish, bearish, volatile, quiet conditions. Don't cherry-pick the results. Ensure your system holds up statistically across varied environments. Then, once you have confidence from backtesting, run a live demo account or a small forward sample with real money, inappropriate for your situation. Track all your key metrics again, win percent, average win, average loss, your calculated expectancy, and also the variance or consistency of your results.
Sure.
Based on these tests, iterate and refine your rules. Keep doing this until your expectancy remains consistently positive and robust across these various testing environments. And always remember, backtests estimate future performance. They absolutely do not guarantee it.
Got it. Test, refine, test again. And finally, once we have a validated system that we're trading live, how do we keep it sharp and ensure it stays relevant as markets evolve?
That's step 6, operationalize a feedback loop. Think of this as ongoing maintenance for your trading engine. You need to log every single trade meticulously, no exceptions. Then, on a regular basis, maybe monthly, maybe quarterly, measure your expectancy drift. Is it improving, holding steady, or starting to decline? And here's the key. Only adjust your core strategy when it's statistically justified by a significant sample of new trades, not based on one bad day or one good week. Treat those emotional impulses we all get, oh, this isn't working anymore, or you need to change something now based on recent performance. Treat those as trade exceptions, perhaps review them, but not as the rule for changing your entire validated system. Your data, over a meaningful sample size, not your feelings, should drive any significant refinements.
This deep dive has truly laid out such a comprehensive roadmap. It's shown us clearly that an edge in trading isn't some kind of mystical intuition or secret signal. It's a measurable mathematical advantage built painstakingly on clear data and disciplined execution. It really all comes down to understanding your profit expectancy and then actively managing those two powerful levers, your strike rate and your reward to risk ratio. This isn't just another metric. It seems like it's the absolute core engine of consistent profitability.
It really is. And this concept, this framework, it empowers you to move beyond that emotional roller coaster of reacting to individual trades. It allows you to build a robust, consistent approach to the market. It's about cultivating a system that works for you statistically over the long haul, rather than just crossing your fingers and hoping for luck on any given day. This framework provides the clarity and the control that serious trading demands. So as you, the listener, reflect on your own trading right now, consider this fundamental question. Do you want to keep guessing, keep hoping whether today's trade will be a winner? Or do you want to engineer a system where the math, the probabilities, pay you consistently over hundreds and thousands of trades, build for expectancy, not for validation?
Powerful final thought. Thank you so much for providing us with these incredibly insightful sources and allowing us to take this really practical deep dive with you today. Until next time, keep learning, keep questioning, and keep refining your edge. Trading an edge where psychology meets profitability.